Ever looked at a price tag overseas and just, well, wondered why that same dollar buys so much more, or maybe dramatically less in another country?
Mm,
Or maybe you've seen some big global event happening far away, right? And then suddenly you realize it's actually impacting your grocery bill. Or maybe your next vacation plans right here at home.
yeah, those ripples can be surprisingly direct.
Exactly. So today, we're taking a deep dive into the source material you've provided on something really foundational, but also constantly shifting the global system of exchange rates.
Right. And
Yeah.
this isn't just about, numbers on a screen or complex economic charts. It's really a fascinating journey through history, economics, and even international politics, which often gets overlooked.
Right.
Our mission today really is to unpack how we went from a world where currencies were literally tied to like actual bars of gold to the incredibly complex, interconnected financial system we have today.
And what that means for us.
And crucially, yeah, what these huge shifts have meant and importantly continue to mean for you.
So to guide us through this, well, it's quite a story, isn't it? We've pulled together insights from some really key thinkers, Danny Roderick, Zeller, Eswar Prasad, Gamso, and Dimitrova, and Frieden.
A great lineup.
Think of this as your kind of shortcut to understanding the godfather of currency stability, as one source put it, the big dramatic shifts over time,
Yeah.
and the really critical choices nations face today in managing their economies.
Absolutely. We'll explore how these systems were actually designed, the thinking behind them, but also where they genuinely succeeded
Yeah.
and maybe where they failed quite spectacularly. And perhaps most importantly, why these historical shifts still cast such a long shadow, influencing everything from, say, international trade deals right down to your country's current domestic economic policies.
It's got deep roots.
It really does. Deep roots and constant relevance today.
Okay, so let's unpack this first bit, the gold standard. Can you paint a picture? Imagine a time when the value of every major currency, the pound, the dollar, whatever, was directly linked to physical gold. Sounds almost quaintly simple now, doesn't it?
It does have that feel.
What was the core logic behind that system? Why gold?
Yeah, it's a great question. Donnie Roderick explains it really well. Gold wasn't just valuable, it was seen as this irrefutable reference point.
Irrefutable, okay.
Because everyone, everywhere, basically agreed on its value, right? It provided this absolute unchanging standard. In a way, he calls it the original godfather of exchange rate parity.
Godfather, I like that.
Yeah, it really laid the groundwork for a lot of modern financial theories we still debate today. It fundamentally shaped how we even think about currency stability.
And having that irrefutable reference point, that anchor, it must have had some big advantages, right? What were the main benefits for the global economy back then?
Oh, definitely. Roderick, he recalls Keynes talking about this period, describing an era where capital, money for investment flowed incredibly freely between countries.
Without fear.
Pretty much without fear of losing value just because the exchange rate suddenly jumped around. It removed a huge layer of risk.
Okay.
He even noted how interest rates in London, New York, and the major financial centers of Europe moved as if they were joined as part of one single market.
Wow. Like one big pool of money.
Exactly. It suggests incredible stability, incredible predictability, at least for international finance and trade.
But there's always a but, isn't there?
Always. And here's where it gets really interesting and maybe less rosy. While it was fantastic for foreign trade and big investors, this system had a really significant, sometimes quite brutal dark side for domestic economies, for ordinary people.
How so?
Well, imagine being a small shop owner, maybe, struggling to pay your rent because there's a long period of deflation, prices falling. Every dollar you earn feels heavier, harder to come by, but your debts, they stay the same. Or, flip side, imagine your family's life savings just evaporating during runaway inflation. And the government can't really do much because its hands are tied by having to maintain that gold link.
So no flexibility domestically.
Very little. The gold standard had the supposed self-balancing mechanism, but it meant domestic economic pain, unemployment, deflation just had to be endured until the global system eventually corrected itself.
Which could take ages.
Often with agonizing time lags, yeah. And these problems were massively amplified by huge shocks like the World Wars. Ultimately, the whole rigid system just became, unsustainable.
Right. So the world wars kind of broke it, or at least exposed its fatal flaws.
Yeah.
It sounds like the system was really pushed to its absolute limit. So what happened next? How did the world try to find that flexibility it so clearly needed?
Precisely. The old way wasn't working. a new approach was needed. And Zoller details how this came about under the Bretton Woods framework, hammered out in 1944, even as World War II was still raging.
Bretton Woods. Okay, I've heard of that.
Yeah, a landmark agreement. It aimed for both stability and some flexibility. It also saw the birth of these huge global institutions we still have today, the International Monetary Fund, the IMF.
Right, the IMF.
Which helps countries facing like balance of payments crises, and the World Bank, which focuses more on development aid and loans.
Okay, and the currency part, how did that change?
Crucially, under this new setup, often called the gold exchange standard, most global currencies were pegged not directly to gold, but to the U.S. dollar.
Ah, okay, so the dollar's the key now.
Exactly. And the U.S. dollar, in turn, was the only currency that was still officially pegged directly to gold at a fixed rate. So it was more like a two-tiered system, an indirect link to gold for most countries.
Okay, so the dollar becomes the new anchor, but it still has this gold backing, theoretically at least. What was the big win here for individual countries? What did they gain?
Flexibility. Well, flexibility within reason, as the source puts it.
Within reason, okay.
They gain the ability to use their own monetary policy things, like changing interest rates, to soften the blows during periods of inflation or deflation. This was huge.
So they weren't completely tied anymore.
Right. If a country faced a recession, its central bank could, say, lower interest rates to try and boost the economy. Under the old gold standard, they might have been forced to raise rates just to protect their gold reserves, even if it made the recession worse.
That makes sense.
And this era, it really highlighted how important it is for governments to think about all their stakeholders, Local consumers, domestic businesses, big banks, exporters. Everyone is affected differently by these policies.
And we still use those tools today.
Absolutely. Many of the monetary policy tools central banks rely on today were really developed and refined during that Bretton Woods period.
But that flexibility, you said, within reason. And you mentioned something earlier, the impossible trinity.
Ah, yes, the impossible trinity, a core concept in international economics.
Explain that again quickly.
Sure. It basically says a country can realistically only achieve 2 out of 3 desirable goals at the same time. First, a stable, fixed exchange rate. Second, the free movement of capital in and out of the country. And third, an independent monetary policy to manage its own economy.
Pick 2 out of 3.
You got it. You can have a fixed rate and free capital flow, but you give up control over your interest rates. Or you can control your interest rates and have free capital flow, but then your exchange rate has to float. Or control rates and the exchange rate, but then you need capital controls. You can't have all 3 perfectly.
Okay, I see the trade-off. So Bretton Woods tried to find a balance.
It tried. It was definitely less punishing than the pure gold standard, but it had its own massive problems. A big one was this growing lack of trust by other countries in the USA.
Why the mistrust?
Well, there were concerns and, frankly, evidence that the U.S. was spending massively printing dollars, especially related to things like the Vietnam War, without having enough gold in Fort Knox to actually back all those dollars floating around.
Oh.
Yeah. It raised questions about the integrity of the U.S. political leaders of the time. And Roderick's point about that peculiar combination of domestic politics, belief systems, and third-party enforcement enabling globalization. It became super clear here. Political choices in one very powerful country started to seriously destabilize the whole global system that relied on its currency.
And this led to a run on the dollar, or gold, rather.
Essentially, yes. Other countries started getting nervous and began demanding gold from the U.S. in exchange for the dollars they held, as they were entitled to do under the agreement. It became a gold run.
So they called America's bluff, basically.
You could say that. The pressure became immense, and ultimately it forced President Nixon to make this really dramatic televised announcement in August 1971. He unilaterally suspended the dollar's convertibility into gold. Effectively, he ended the Bretton Woods system, pulled the plug.
Wow, just like that.
Just like that. And Zoller points out something critical here. This whole episode shows how powerful countries, if they're kind of left unchecked, can potentially use institutions like the IMF or World Bank, or just their sheer economic weight for their own political or economic goals.
Even unintentionally causing problems.
Exactly. Even unintentionally, it can cause huge structural shifts in global finance. And that concern hasn't gone away. Gamso and Dimitrova's research, for instance, found this positive link between countries supporting U.S. foreign policy and getting better insurance terms from MIGA.
MIGA?
Yeah, it's the Multilateral Investment Guarantee Agency, part of the World Bank Group. It insures foreign investments against political risks.
Okay.
Their research suggested that Basically, political alignment could influence financial benefits distributed by these international bodies. It really underscores how politics and finance are deeply intertwined on the global stage.
So Nixon slams the gold window shut. Bretton Woods collapses. What happens then? The world's financial anchors are just gone.
Yeah.
Suddenly, currency values aren't tied to gold, not even indirectly through the dollar anymore.
Right. Chaos? Well, not quite, but definitely uncertainty. Values were now left to something much more dynamic, maybe more volatile.
Yeah.
The forces of global demand and supply. The market.
So how did the system adjust? What replaced the old rules?
Well, the market itself started to provide the discipline, in theory. What the sources call the corrective nature of the foreign exchange market and the tendency of reversion towards parity to eliminate arbitrage became the new stabilizing forces or substitutes for them.
Okay, break that down. Arbitrage, parity.
Sure, arbitrage is just taking advantage of price differences in different markets. If a dollar buys more euros in London than in New York, traders will instantly buy euros in New York and sell them in London, pocketing the difference.
Until the prices match up.
Exactly. That buying and selling pushes the prices back towards parity, towards being equal everywhere. So these market actions automatically tend to correct imbalances and keep exchange rates roughly aligned based on underlying economic factors. It's a kind of self-correction driven by profit seeking.
Okay, that makes sense. But what's really fascinating, though, is that even after the U.S. effectively broke the system, decoupling from gold, the dollar still somehow managed to stay the world's dominant trading currency. You'd think that move would have really damaged its status. Why did it hold on?
Yeah, it is pretty remarkable. Esra Prasad points to a few key reasons. Firstly, just inertia and efficiency. The global system was already deeply wired for using dollars. Changing everything overnight would have been massively disrupted and costly, so the efficiency of trading in USD globally was a big factor.
People stuck with what they knew.
Pretty much. Plus, you had the sheer size of the U.S. economy. It was and still is the world's largest. Then there was the perception of its democratic government. Despite controversies, it offered more political stability than many alternatives at the time.
And the legal side.
Right. And crucially, the U.S. had already established strong support institutions and legal frameworks, like deep, liquid financial markets and reliable contract enforcement that made doing international business in dollars relatively safe and easy. All of these things together helped cement the dollar's dominance even after the gold link was severed.
So fast forward to today. We've got this world where currencies mostly float, driven by markets, but countries still make choices. You see exchange rate regimes on a whole spectrum, right? Some countries still peg their currency, maybe to the dollar or a basket of currencies, while others let it float completely freely. How do they decide? It must be a really tough call.
Oh, it's absolutely a critical and difficult decision for any government. And Frieden explains that it loops right back to that impossible trinity we talked about.
Right, stability, monetary independence, capital mobility. Pick two.
Exactly. A country's choice depends heavily on which two of those three pillars it prioritizes. And it's not just a simple fixed or floating switch. It's more nuanced. Think of it as a multidimensional manner of analysis.
How so?
Well, not just whether the rate is fixed or floating, but also policy considerations around wanting a relatively weak versus strong currency, depending on the country's economic structure and goals.
Okay, so this isn't just abstract economics. It sounds like socio-political factors must play a massive role here. Because these choices, they hit different groups of people very differently, right?
Precisely. Think about it. Businesses that do a lot of international trade, importing or exporting, they generally love exchange rate stability. It reduces risk, makes planning easier. They might be willing to give up some domestic monetary control for that predictability.
Makes sense for them.
But then you have domestic businesses or just regular consumers. They often prefer a floating regime because it means their government keeps control over monetary policy, interest rates, money supply, which can be used to fight recessions or manage inflation, things that directly impact their jobs and cost of living.
So a fundamental tension there.
A huge tension. And it leads directly to that other big question governments face. Is a strong currency actually better, or is a weak one better?
Yeah, you hear arguments for both all the time.
Right. For domestic consumers, a stronger currency feels great initially. Your money goes further when buying imported goods, cheaper electronics, cheaper foreign holidays. It can boost your standard of living. But businesses that export goods get hammered. Their products suddenly become more expensive for foreign buyers, so they lose competitiveness, potentially leading to job losses in those export sectors.
And the flip side, a weaker currency.
Export businesses often love a weaker currency. It makes their goods cheaper abroad, boosting sales and potentially creating jobs. But
But imports get more expensive for everyone.
exactly, everything from imported fuel to food to medicine costs more. That can really squeeze household budgets, especially for lower income families, and reduce the overall standard of living. It's this constant, delicate balancing act.
So it really depends on the country's economic makeup.
It seems so. The sources suggest that countries with a really large base of domestically confined manufacturers and consumers, economies more focused inward, might lean towards wanting a stronger currency to keep import costs down for their population.
While export giants might prefer a weaker one.
While countries with very open economies, heavily reliant on international trade and exports, might find a weaker currency more beneficial for their overall growth and employment, even with the downside of higher import costs. There's no single right answer.
It's all about trade-offs. Which brings us, I think, to a really crucial point that kind of ties this whole historical journey together. The politics of it all. The political economy of exchange rates.
Yes, Frieden really emphasizes this. It's emerged as an incredibly important lens for understanding exchange rate policy, both for developing and developed countries.
How does it differ between them?
Well, often developing nations might be more intensely focused on the immediate domestic political fallout, how policies affect jobs, prices, poverty right now. Their leaders have to be very sensitive to that.
Whereas richer countries.
Developed countries, well, certainly not ignoring domestic politics, also have to grapple more with the global implications of their currency's value. How does it affect international investment flows? What's its role in the global system? And, as we discussed, they also face scrutiny over the potential misuse of international institutions by powerful countries, using things like aid or IMF conditions to push their own global political agendas.
Like the MIGA example.
Exactly. That potential for political influence shaping financial outcomes is a constant theme. It's this complex interplay of national interests, domestic pressures, and global power dynamics.
So looking back at this whole sweep of history, from gold bars firmly fixing values to the dollar anchor of Bretton Woods to today's much messier floating world, what's the single biggest takeaway for you? Thinking about our listener, this isn't just dusty history, right? It's about navigating the world we live in now.
Absolutely. For me, the critical takeaway is that countries, big or small, need to be incredibly aware of the potential unintended outcomes, the ripple effects of exchange rate policies, and the decisions made by major global players. Things happening far away can wash up on your shores unexpectedly.
So what's the defense? How do countries protect themselves?
Well, the best defense, the most robust strategy, according to the sources, is to proactively build strong domestic macroeconomic conditions. Meaning sound government finances, keeping inflation under control, having a well-regulated banking system, maybe diversifying the economy so you're not reliant on just one export. It's about building a strong internal foundation, a resilient economic house.
So you can better withstand those global storms when they inevitably hit.
Precisely. It's about building that domestic resilience to insulate your economy as best as possible from negative external shocks.
Wow. Okay, what a fascinating deep dive based on these readings. We've gone from the sort of rigid simplicity of the gold standard through the compromises and collapse of Bretton Woods, landing in the complex, floating, and highly politically charged landscape of today's exchange rates. We've really seen how much has changed, but also how many fundamental challenges, those trade-offs, those political pressures really remain for nations all around the world.
And if we connect this to the bigger picture, what it really highlights is that behind every single currency valuation you see flicker on a screen, behind every trade agreement signed, behind policies of institutions like the IMF and World Bank, there's always this incredibly delicate, often precarious balance.
That balance between what?
Between pure economic theory, raw political will, and the very real lives and livelihoods of ordinary people and businesses. And maybe this leaves us with a provocative thought for you, the listener, to mull over.
Okay, let's hear it.
In this world that's becoming ever more interconnected, where global power dynamics clearly continue to shape international finance, and where every nation faces these tough choices forced by things like the impossible trinity, how much genuine autonomy can any nation truly achieve? How much power does it really have to fully protect its own people, its domestic stakeholders, from the sometimes turbulent waves of the global financial system?
How much control is really possible?
Exactly. Something for you to perhaps ponder as you watch the global headlines unfold.